Okay, business and sorry, financial accounting. Financial accounting. So we have covered till chapter 20, chapter 19, and we have covered chapter 21.
21, yeah.
So there are two chapters left, chapter 22 and chapter 20.
Yes.
Chapter 21 and chapter 22 both are relating to consolidation. And we have covered one chapter 21 relating to consolidated statement of financial position. So let's discuss about consolidated statement of profit and loss account. We have learned in a statement of financial position consolidation, we need to add everything. Instead of investment in subsidiary, we need to record goodwill. How we can calculate goodwill, we have learned.
Yes.
Share capital, we record only for the parent company. Other reserve, we record only for the parent company. And we need to calculate non-controlling interest if holding is less than 100%. So let's discuss how we can consolidate statement of profit and loss account. How we can consolidate statement of profit and loss account. It's very simple, very easy. What we need to do in consolidation, suppose this is parent company data, this is subsidiary data, and P have acquired 70% of the equity share capital of subsidiary. This means 25% holding is of NCI, non-controlling interest. What we need to do, revenue, we need to add both together. That will become 1600. Cost of sale, we need to add both together. That will become how much? 1440.
Yeah.
We will calculate GP 160. Admin expenses we will add together 105. We will calculate profit before tax. That will be 55. Tax we will both add together and we will arrive at a profit of 34. So after calculating this profit, this is a subsidiary profit 4. Out of this 4, 75% is of parent company,
Parent company 25%.
while 25% is of NCI. So what is the NCI profit out of these 4? 1. What is the parent company profit of these 3? So what we need to do, we need to calculate here share of NCI 1, and then we will deduct this 1.
Of the net profit.
And there we need to record what is the profit for parent company. So parent company profit is 33. That's what we need to show at the end.
In the end.
In the end only. Mean we need to distribute the profit, like out of these 4, how much is parent, how much is subsidiary. Like they have calculated. So 34. So non-controlling interest is 1. And what is the group profit attributable to group? That is 33, altogether 34. Is that fine?
Yeah.
So we will say, what is this? Group profit instead of parent. We'll say this is group profit. Or profit attributable to group. Profit attributable to non-controlling interest. We will deduct. We will arrive at profit attributable to group. Okay, let's move forward. We have learned in previous lecture, there could be some intra-group transactions. Intergroup transactions like parent, subsidiary, having any intergroup transaction like a parent have sold some goods to subsidiary. And subsidiary sold some good to parent company. What we need to do for that? We need to deduct that sale from the revenue. We need to deduct that purchases from cost of sale. And if there is any unrealized profit, like if any inventory involved in intergroup transaction and is unsold at the year end, we need to calculate profit part of that unsold inventory. That should be deducted from closing inventory.
Closing inventory.
As closing inventory is going to be deducted from cost of sale. So for non-controlling for unrealized profit, we need to add. So sale will be deducted, purchases will be deducted from cost of sale, and we need to add unrealized profit part. Let's discuss this example. On January 1, 20x9, P acquired 60% of equity share of S. The following statement of profit or loss have been produced by parent and subsidiary. This is parent company reserves, this is subsidiary reserves. Revenue,
And
cost of sale, GP, distribution cost, admin expenses, profit from operations, investment income from S. Where they are receiving this income from S. S mean their subsidiary. Profit before tax, taxation, profit for the year. During the year ended 31st December 20x9, P had sold 42,000 worth of goods to SP is a parent company, S is subsidiary. So there is a 42,000 sale recorded in parent company of 42,000 and purchase recorded in subsidiary of 42,000. So this is in parent company, this is in subsidiary. So both we need to deduct from sale as well as cost of sale. In consolidated financial statements, we will deduct 42,000 from sale and 42,000 from cost of sale as purchasing. These goods had cost of 28,000. This means how much is the profit that is unrealized total? 42 minus
28.
28, how much is that? 14,000.
Yeah.
On 31st December 20x9, S still had half of these goods in inventories at the year end. So half sold mean half profit realized. So remaining half is unrealized. So that we need to add in cost of sales. So in consolidation, we will deduct the 42,000 from sales. We will deduct the 42,000 from cost of sales, and we will add 7,000 as unrealized profit. How? What they have asked? Calculate group revenue and cost of sale for the year ended. So group revenue and cost of sales. So both revenue will be added minus 42 and both costs will be added minus 42 and add unrealized profit. So this will be cost of sale. Is it fine? Let's move forward. There could be mid-year acquisition. If subsidiary is acquired at the start of the year, we will add complete result of subsidiary. If subsidiary is acquired during the year, like year end is 31st December and subsidiary was April. This means from January to March result, we will not consolidate. We need to consolidate April to December results only. This means for subsidiary result, we need to multiply by 9/12. If subsidiary is acquired during the year. So from date of acquisition onward, we need to consolidate the results, not before date of acquisition. Mean post-acqui results. There are two terms, pre-acqui and post-acqui. Pre-acqui mean before acquisition results, we will not consolidate. We need to consolidate post-acqui results, mean after date of consolidation. Mean in the financial statements, they provide the complete year results. So we need to multiply by number of months. How? Like this, see. The following statement of profit and loss have been produced by parent and subsidiary for the year ended 31st March 20x9. 31st March is the year end. Revenue, cost of sale, GP, distribution cost, profit from operations, investment income, profit before taxation, tax, profit for the year. On 30th November, mean if year end is 31st March, when it was started? 1st of April 20x8. In if year end is 31st March, so this year was started, what date? 1st of April 20x8. So on 30th November 20x8, P acquired 70% of the issued equity share capital of S. So how many months are post equity? 30th November. This means December, January, February, March, 4 months are post equity, mean we need to consolidate 4 out of 12 subsidiary results. So for every subsidiary figure, we will multiply by 4 by 12 and then consolidate. No dividend were paid by either entity during the year. The investment income is from listed investment and has been correctly accounted for. The profit of both entities are deemed to accrue evenly over the years. So how we will consolidate this plus 108,850 into 4 by 12? What is the amount we will add with this? Again, cost of sale, we will multiply by 4 by 12 and then we will add to this. How? See this. Revenue parent company complete, subsidiary into 4 by 12. Cost of sale parent company complete, subsidiary into 4 by 12. Operating expenses parent company complete for subsidiary into 4 by 12. Profit from operations, we have calculated. Investment income parent company complete and subsidiary into 4 by 12. Profit before tax, taxation, parent company complete, subsidiary into 4 by 12, and we have calculated profit. Now we need to see what is the share of non-controlling interest. So subsidiary complete profit is 16,400.
Yes.
Out of this, 25% is of non-controlling interest. Out of this, 25% is of non-controlling interest
4,000.
and 75% is of parent company. So how we will calculate 16,400 is total profit into 4 by 12 into 25% is the share of non-controlling interest. So remaining is the profit attributable to group. That's your understanding too. Set out below the draft statement of profit or loss of P and S. Year end is 31st December. On 1st January, P purchased 75% of equity shares in S. So at start of the year, so complete result will be consolidated. You know?
Yes.
So during the year, S sold goods to P to 20,000, making a markup of 1/3 markup on cost. Only 20% of these goods have been sold before the year end. Can you calculate profit figure for me? If sale value is 20,000, so sale is equal to cost plus profit. And markup,
It's 20%.
making a markup. How much is a markup?
Markup is 1/3. 1/3 means 1 by 3.
1/3 mean profit is 0.333.
3.
This means this is 100 and this is 33.
Yes.
1/3 means 33%. So this means this is a 133 and we're having this 20,000. And this itself is a 133 and we need to calculate 100 or 30. We can calculate. If 100, what is that? 100 out of 20,000, how much is cost? 15,000.
15,037.5. 15,038.
15,038, or you can say complete 15,000.
Yeah,
So 15,000 is what the cost.
cost.
This means 5,000 is profit. Out of this, 20% of these goods have been sold before the year end. This means 80% profit is unrealized, and 5,000, 80% is 4,000. So that we need to add to cost of sale, and this amount we need to deduct from both the cost of sale as well as sale. And this chapter is finished. Just we need to read this one paragraph about associate. If parent company acquired more than 50% of other company, so we'll call it subsidiary.
Substitute.
But if parent company acquired less than 50% and greater than 20% of other company, we will call it associate.
Associate. Less than 50.
We will call it associate.
Associate.
If holding is less than 20%, it's neither subsidiary, neither associate. And in associate, we do not combine result of other company. In case of subsidiary, we need to combine all the result of subsidiary and parent.
Parent.
But for associate, we do not need to combine the results. What we need to do, we just need to see how much profit associate have generated. What is our percentage of that profit? Only that profit we get. Not all the account balances, only profit. Mean income from associate we need to account for into parent company. We don't need to account for all the results of associate. So an associate, what is associate? Is an entity over which the investor has significant influence. And what is that significant influence? Above 20%, less than 50%. Please note that joint ventures are not part of the syllabus of this paper. We will learn in financial reporting paper. Significant influence is the power to participate in the financial and operating policy decision of the investee, but is not control or joint control over those policies. Investor is an entity which owns a shareholding in another company, and investee is the entity in which another entity has a shareholding. Mean parent company is investor and other company is investee. An investor is presumed to have a significant influence over another entity when it has a shareholding in that other entity between 20% and 50%. Mean above 20%, but below 50%. If holding is above 50, then subsidiary. If holding is below 20, neither subsidiary nor associate. So 100% of the assets and liabilities of the parent and subsidiary entity on a line by line basis, mean we don't need to consolidate associate. A single investment in associate line with the non-current asset, which include the group share of and liabilities in any associate. Meanwhile, preparing balance sheet, whatever we have made investment in associate, that we will record as asset. Investment in associate. And whatever we are getting from the profit of associate, that we will record in profit and loss account, mean income from associate. So the consolidated statement of profit and loss, 100% of the income and expenses of parent and subsidiary, not associate. A single share of profit of associate line, which include the group share of any associate's profit and tax. Mean for subsidiary, there will be line by line consolidation. But for associate, there is only one line accounting for statement of financial position, and there is only one line accounting for statement of profit and loss account. And this chapter completed. Let's move towards next chapter. You have studied accounting anywhere, like in your previous studies, this chapter you have already studied. Chapter 20. Chapter 20 is about interpretation of financial statements.
Interpretation of
In simple words, you can say financial ratios. Financial ratios. Suppose there is a company A and a company B. Company A sale is 100,000, or you can say 1 million. Company B sale is say 10 million. Company A made a profit of say 100,000, while company B profit is 200,000. Which company performed better? A or B?
Company
How? Company A sale is just 1 million, while company B sale is 10 million.
but the profit is less.
Company A profit is 100,000. Company B profit is double than company A 200,000.
The revenue.
If we just see at the figures, so we'll say its sale is higher, its profit is also higher, it has performed better, but no.
No.
Who has performed better? We need to check what is the profit margin
Margin.
against sale. Company A have generated 10% profit margin. While company B have generated how much? Only 2% profit margin. Mean they have made 10% against their investment into the business, and they have generated 2% against investment in the business. So company A have performed better as compared to company A. That's why we need to calculate ratios to interpret financial statements, mean which company have performed better. We can interpret by calculating different ratios. Either we can compare these ratios with other company, or we can compare these ratios with the two different years of the company. Like previous year, what was the profit margin and what is profit margin in the current year? We will see whether company is performing better or performing poor. So we need to calculate ratios either for our company and other company so that we can compare who is performing better, or we need to compare ratio for 1 year with other year to compare whether we are performing better than before or poor than before. And there are different types of ratios that we need to learn. There are some ratios relating to profitability that we need to learn. Some ratios relating to liquidity, some ratios relating to efficiency, and some ratios relating to position. What are the ratios relating to profitability? Gross profit margin, that we call it GP margin. How we can calculate GP margin? Gross profit over sales into gross profit over sale into 100. Before moving to ratios, let's discuss from sales. we deduct cost of sales and we arrive at gross profit. From gross profit, we need to deduct operating expenses. What are the operating expenses? Selling and administration expenses.
Yes.
Or we can say we need to add distribution expenses, advertisement, etc. We arrive at profit before interest and tax. From this, we need to deduct interest, also called finance cost. We will arrive at a profit before tax. PBT stands for profit before tax, and PBIT, profit before interest and tax. And from profit before tax, we will deduct the tax. We will arrive at profit after tax. In some ratios, we need to use profit before interest and tax. In some ratios, we need to use profit before tax, etc. So GP, what is the formula to calculate GP margin, gross profit over sale into 100? And what this tells about? What is gross profit? It's a combination of sale minus cost of sale. This means if suppose gross profit has increased, what could be the reason? Either sale has increased, either cost of sale has decreased. So sale has been increased due to selling prices increase. Or if company is selling so many products, might be some products sale has increased, other remain same. That is called product mix. If cost of sale has increased or decreased, it could be due to purchase cost. It could be production cost or could be inventory valuation. The reason behind change in gross profit margin. Profitability ratio, another profitability ratio is called operating profit margin. How to calculate operating profit margin? That is also called profit margin. Profit over sale into 100. What profit? Profit before interest and taxes. That is also called profit from operations. Profit over sale into 100. Profit before interest and tax. And this profit is calculated after deducting admin expenses, selling distribution expenses from gross profit. So what could be the reason? Change in employment pattern, mean due to that might be salaries and wages has increased when operating expenses have changed. Change in depreciation. Write-off of irrecoverable debt, that is also recorded under operating expenses. Change in rental agreement, mean either rent has been increased or decreased. Advertising expense has been increased or decreased, or fuel cost, mean distribution cost might have increased or decreased. The third profitability ratio will be called return on capital employed. And to calculate return on capital employed, formula is operating profit, mean profit before interest and tax divided by capital employed.
Investment.
What is capital employed?
Equity.
Equity plus long-term liabilities, mean loans. Or we can say capital employed is total assets,
Total assets.
mean current plus non-current assets minus current liabilities. We are familiar with the statement of financial position, mean balance sheet. Mean first we need to record, if we talk about statement of financial position, we need to record non-current assets like land and building, etc. In that, we need to add
Current assets.
current assets, inventory. What involves in current assets? Inventory, receivables, repayments, cash in hand or bank. And if we will add all these four, we will arrive at total current assets. And if we add both the assets, we will arrive at total assets. And then under total assets, we need to record equity.
Equity.
Equity means share capital,
Share capital.
reserve,
Reserves.
also called retained earning. In the profit we are earning during the year will be added to it. So we will calculate total equity. Then we need to record non-current liabilities. What are non-current liabilities like a loan, etc. And then we need to record current liabilities like a payable, bank overdraft. So total equity and liabilities. And these two amounts should equal to each other. So what is capital employed? Capital employed is equity plus long-term liabilities. And equity, long-term liabilities and current liabilities should be equal to total assets. If we deduct current liabilities from total assets, we will arrive at the capital employed. We deduct current liabilities from total assets, we will arrive at capital employed. So in question might be examiner have given data about equity, non-current liabilities, or if they have given data about total assets and current liabilities, we can still calculate capital employed. So what this ratio tells about return on capital employed, if it is more as compared to previous year or as compared to other company, we will say company have utilized its asset much better. I mean, this is your investment and this is your profit. If it is increased, this means profit has increased. This means company have utilized its asset much better way as compared to previous year or as compared to other company. If it is decreased, company is failed to utilize its asset in better way. So we have learned three profitability ratios: GP margin, operating profit margin, and return on capital employed. How to calculate GP margin? GP over sale into 100. Operating profit margin, operating profit over sale into 100, and return on capital employed, profit before interest and tax over capital employed into 100. How to calculate capital employed? Equity plus long-term liabilities. There is another ratio, profitability ratio called asset turnover ratio. What's the formula to calculate asset turnover ratio? Sales divided by capital employed. Capital employed is also called total assets minus current liabilities. That is also called net assets. Net assets mean total assets minus current liabilities. So how to calculate ROS, PBIT over capital employed? How to calculate asset turnover? Sale over capital. And there is a relationship between asset turnover and operating profit margin. Operating profit margin formula is a profit over sale. Asset turnover formula is a sales over capital employed. If we multiply both ratios, operating profit margin
Turnover.
And asset turnover, this means this is sale will be cancelled.
Cancelled.
So we will arrive at ROS, operating profit margin over capital employed. Is that fine? So these are 4 profitability ratios.
Ratios.
What are the profitability ratios?
Gross profit margin,
Profitability ratios. Gross profit margin,
operating profit,
operating profit margin, return on capital employed, and asset turnover. Now we are moving towards liquidity ratios. What are the liquidity ratios? Current ratio. How to calculate current ratio? Current assets over current liabilities. Current assets over current liabilities. We don't need to multiply by 100. We don't need answer in percentages. The answer will be either 0.8, 1.5, could be 3.7, like this. How we can interpret current ratio? If the answer is above 1, we will say it's better. If the answer is below 1, we will say it's poor. What is shows? Suppose current assets are of 10,000, while current liabilities are of 5,000. So current ratio will be 2. Mean assets are double by current liabilities. Mean company is managing its short-term cash flow in better way. But suppose current liabilities are more than current assets, it will be below 1 in 0 point something. This means current liabilities are more than current assets. This means company is struggling to manage its short-term cash flow. Company is struggling to manage its short-term cash flow. What is the other liquidity ratio? Quick ratio, also called acid test ratio. Quick ratio or acid test ratio. How to calculate? Current assets minus inventory over current liabilities. Again, answer above 1 is positive. Meanwhile, we are deducting inventory because inventory is not a liquid asset. Liquid means that can be converted into cash quickly. The other assets like cash, receivables can be converted into cash quickly. From receivable, we receive cash. Cash in hand, cash in the bank is cash. So mean how company managing its liquid asset. We will calculate quick ratio, also called acid test ratio. So 2 ratios, liquidity we have learned: current ratio, current assets over current liability, and quick ratio, current assets minus inventory over current liability. What are the other liquidity ratios? Inventory turnover period, also called inventory days. How to calculate inventory? Which inventory? Closing inventory. That is appeared in current assets in balance sheet. Over cost of sale into 365 days in a year, the answer will be in days. So the answer is 35 days, or the answer is say 60 days.
Sir, I will, Malik sir told this in performance management chapter.
In the yeah. So if the answer is 35 days, this means the inventory is stuck in the business for 35 days. Mean after keeping inventory for 35 days, we can convert into sale. If inventory days has increased to 60 days, this means inventory remains stuck in business for 60 days. After 60 days, it will convert into sales. So this is poor. This is
Less days,
better.
better.
Less days, better. More days, poor. What are the other efficiency ratio? Debtor days are called receivable collection period. how we can calculate receivable collection period, also called debtor days, trade receivable over credit sale into 365. And answer will become in days like 30 days or say 50 days. What does this ratio tells about? In how many days we are receiving cash from the customer, credit customers. If we are receiving cash in 30 days, that's better. But if we are receiving in 50 days, that's poor. Mean our cash is stuck with the customer for 50 days. It could become bad debts, or we will struggle to manage our cash flow. What's the other liquidity ratio? Creditor days are payable payment period, also called creditor days. How to calculate trade payables over credit purchases into 365. If you don't have credit purchases in the question, you can use cost of sale. The answer will be again in days, either say 30 days or say 45 days. What does this mean? In how many days we are paying cash to the supplier? If we are paying after 30 days or after 45 days, what will provide benefit to us?
45 days.
If we pay later, because we can use that cash in the business. So more is better, but it shouldn't be too much more. Otherwise, creditor will not treat us properly. Our relationship with creditors might be affected. So what are the efficiency ratios? Efficiency ratio. Current ratio, current assets over current liabilities.
Quick ratio
Quick ratio.
or asset ratio.
What is the other name of quick ratio?
Asset ratio.
Acid test ratio.
Asset test ratio.
Current assets minus inventory over current liability.
Inventory turnover.
Inventory turnover period. Inventory days. What's the formula to calculate inventory turnover period?
Inventory by cost of sale.
Inventory over cost of sale into 365. The answer will be in days. If examiner asked to calculate answer in months,
Well,
then we will multiply by 12.
well,
If examiner asks, no, give me answer in weeks,
54.
52 weeks in a year. So we'll multiply by 52. If in days, 365. Receivable
Receivable collection period.
collection period mean how many days we are collecting from receivables. So receivables over credit sales into 365. Payable payment period. Payable over credit purchases into 365. If no credit purchases, we will use cost of sale. Another called trade cycle, also called cash operating cycle. Trade cycle or cash operating cycle. How to calculate a trade cycle or cash operating cycles? Inventory days plus receivable days
Plus ratio.
minus payable days.
Minus.
We can calculate cash operating cycle or trade cycles are also called cash cycle. How to calculate this? Inventory days, we will add, receivable days, we will add, and payable days, we need to deduct. Is that fine? So we have learned profitability ratios, we have learned efficiency ratios. Now moving towards financial position ratio. There is a ratio called a gearing ratio. And there are two formulas to calculate a gearing ratio. One is a debt over equity, but the better formula is a debt over equity plus debt. Debt mean long-term liabilities, loans. Equity mean share capital plus retained earnings. What this ratio tells about? The answer could be in percentages, mean we need to multiply by 100. The answer could be 40%, or we can say the answer is 75%. What this ratio tells about? Debt over equity. If the answer is greater, this means you are having more debts less than equity. This will say company is more risky. Company is going towards insolvency. Mean company future is not bright. If it is low, it's better. Mean company gearing is low, company is not near to insolvency, company is less risky. And if company is less risky, investors will be more attracted towards your business. You can get equity easily by issuing shares. You can get bank loan easily. If your gearing is already high, you are a higher risky company from investor point of view.
What if
You will struggle to get money from shareholder in terms of equity, or you will struggle to get money from bank in terms of loan.
what if there is no debt in the outcome?
Then gearing will be 0%. Mean you will be not risky. Everybody will try to invest in your company. People will prefer to invest in your company. If gearing is more, people will not prefer to invest in your company because your company is already high risky. You're already having more debts. Debts mean somebody is having a control over your asset. Because if you will not pay the debt, they can sell your asset and collect them. So gearing ratio. Another financial position ratio is called interest cover ratio. How to calculate profit before interest tax over interest payables mean interest expense. The answer will be in a times. Either say answer is a 4 or answer is a 10. What does that mean? If the answer is a 4, this means from given profit, company can pay 4 interest installments. The answer is 10. From the given profit, company can pay 10 interest installments. So more, better.
Yes.
Less, good. Because company can pay only 4 installments from its profit. And after paying 4 installments, company will not be having money. This means company is more risky. Company can pay next 10 interest installments. This means company is less risky.
Less risk.
Let's discuss this question. We have finished. So company, current year end is 30th June and current year data, previous year data. Revenue, cost of sale for both years. Gross profit, operating expense, profit from operation. Profit from operation mean PBIT. This is profit before interest and tax. Less finance cost mean interest. Profit after before tax mean PAT or PBT. PBT, and we are having PAT mean profit after tax. And for balance sheet, non-current assets, current assets, inventory, receivable, bank, equity, share capital, share premium, reserves, retained earnings. In everything is part of equity. Long-term loans, also called debt, and current liabilities. What we need to do, The directors concluded that the revenue for the year ended 30th June 2024 fell below budget and introduced measures during the year ended 30th June to improve the situation. These include cutting selling price, extending credit facility to customer, lasting additional machinery. Directors are now reviewing the results for the year ended 30th June, but by comparing the figures, they cannot check the performance.
Yes.
What they want.
Operating patients.
Calculate ratios for and comment upon the profitability, liquidity, also called efficiency, and financial position of Navede. So what you need to do? You need to calculate profitability ratios.
This question will be of like long question time.
Yeah, I mean you need to calculate a GP margin for both year 20x4, 20x5, profit margin for both year 20x4 and 20x5. And then you need to calculate return on capital employed for both years. And you need to calculate assets turnover. And you will calculate by yourself. And after that, you need to calculate liquidity, also called efficiency ratios. What are the liquidity and efficiency ratios? Current ratio,
Current ratio, quick ratio,
quick ratio,
inventory turnover,
inventory turnover ratio,
receivable,
receivable collection period, payable collection period,
collection period,
or payment period,
payment period, cash cycle,
and cash cycle, cash operating cycle, trade cycle, or cash cycle. Then we need to calculate financial position ratios. In financial position, we need to calculate gearing, and we need to calculate interest cover ratio. What could be the formula? For GP, the formula will be
gross profit over sales revenue 200.
gross profit over sales into 100. For operating profit margin,
Profit before interest.
PBIT over sale into 100. For ROS, PBIT over capital employed, mean equity plus long-term liabilities,
into 100.
into 100. For asset turnover,
Sales revenue over capital.
sales over capital employed into 100. The answer will be in times.
In times.
Current ratio, current assets over current liabilities. Quick ratio, current assets minus inventory over current liabilities. Inventory turnover, inventory mean closing inventory divided by cost of sale into 365. Receivable collection period, receivable over credit sales
into 365.
into 365. Payables over credit purchases into 365. And cash operating cycle, inventory period plus receivable collection period and minus payable period. For gearing, debt over debt plus equity and interest cover, PBIT over interest. So you will solve this question by yourself. And then this chapter will be ended like they have calculated these ratios. After calculation, you need to compare with this. And if we look at profitability ratios. GP margin has decreased as compared to previous year. Operating profit margin has decreased as compared to previous year. ROS has decreased as compared to previous year. Even asset turnover has slightly decreased. And they have provided some reason over there because you have reduced the sale price, might be cost of increase, might be depreciation has additional provided because you added more asset to the business. So this is the commentary. And then inventory days has decreased. Good or poor? Good.
Good.
Why they has decreased? Because you have reduced selling price, so there will be more demand.
Yes.
Debtor days too much increased
One.
because company providing more credit to the customer and will become bad debts in future. Creditor days has increased,
Good.
mean paying later to the supplier. Current ratio from 1.6, it has reduced to 1.2. Why? Because current liabilities has increased. Mean before it was 1.6. Now it has decreased to 1.2. Mean current liabilities has increased or either current asset has decreased. And quick ratio from 1.2, it is becoming 1. Though above 1 is better, but as compared to previous year, it has reduced. And then for financial position ratio, interest cover from 16.8 to 17.9 improved, mean company can pay more interest installment from the given profit. While gearing is also decreased, mean company is becoming less risky, mean more stable, will help to attract new investors. So that's all. Finish syllabus. Complete course done. Now it's your turn. You need to revise, you need to practice skill questions and attempt the paper to pass it.